This is Al Brooks, and this is my price action trading course. This module is about trading a strong bear breakout. A strong bear trend, it does not matter what you call it. You can call it a strong bear trend, a breakout, or a spike. All of those terms are synonymous. However you call it, the important thing that you should remember is that you have to sell. Okay, what are the signs of a strong bear breakout? First of all, big bear trend bars, especially consecutive strong bear trend bars. Small tails, closes near the low, big bodies. And also you'd like to see the context supporting lower prices. The big picture has to make sense. You got to make sure that it's not just a sell vacuum to the bottom of a trading range. Once you see a strong bear in the breakout phase, dropping bar after bar after bar, you have to get short. To make money, you have to do what the institutions are doing, and the institutions are shorting. If you look at the volume of those bars and those bear spikes, it's heavy, and the market is falling quickly, and it's because institutions are selling repeatedly. Okay? So if you're not short, sell at the market. One of the problems traders face is they'll see the bear spike growing and growing and growing, and they know that if they short, their stop is way up at the top of the spike, and they're risking far more ticks than they normally like to risk. It doesn't matter. Calculate how many ticks you have to risk and adjust your position size, but you have to get short. If you don't sell at the market, you have to get short very soon. For example, you can sell at the close of any strong bear trend bar, and if you're in a strong bear spike, sell at the close of a bull trend bar. The bull trend bar is an attempt to reverse the trend, and most reversals fail. You can sell below the low of the prior bar and above the high of the prior bar, because if the market goes above the high of the prior bar, it's trying to reverse, and the reversal, probably 80% chance, will fail. You also press bets and sell breakouts below swing lows. So if the market is falling and pulls back, and it falls below that old low, you can press your bets and sell on a stop one tick below the prior low. And also, you want to sell any small pullback. When the market's in a strong trend, the trend entries always look bad. There's always something wrong with them. It always looks like the market is trying to reverse. For example, here's a doji signal bar. Here you're far from the moving average, bottom of a tight channel. Maybe it's overdue for a correction. Here you're following 2 bars up and you have a doji signal bar. The market always looks like it's set up for a regression to the mean, that it's gone too far and that it has to correct. But when you're in a strong trend, it does not have to correct. It can go a long, long way. When a trend is very strong, one way you can enter is looking for a micro trend line failed breakout. So you look for a bear micro channel, you look for a breakout above the bear micro channel, and that sets up a low one short setup, and you can sell one tick below the low of the bar as the market resumes down. So a small bear micro channel, a failed breakout above the top of the channel, so you sell at one tick below the low of the bar. Same with over here. Same with over here. And even more so over here when the market is in a free fall. Yes, an attempt to reverse, but most reversal attempts fail, especially when the market is falling with consecutive bear bars and the bars are getting bigger and bigger and bigger. So you get a pullback, it breaks above the micro channel, and that sets up a signal bar for a short. Even though you have 2 consecutive bull bars, it's a reasonable short, one tick below. Certainly for a swing, maybe for a scalp. There are stock replacement strategies for bearish positions, and if a trader finds that his stop has to be so far above his entry price that the position would be so small it's not worth taking, yet he feels the trend is strong and he wants to participate, he has a stock alternative. He has an alternative to his stock, and that is in the options market. He could buy a put, or he could buy a put spread. let's say he sold way up here and the market's way down here, and his stop has to be much higher up than what he is comfortable using. He could just buy back his stock, his short, for a profit, and then go ahead and put on an option position like buying a put or buying a put spread, and that will allow him to continue to participate on the downside. There are other alternatives like ratio put spreads and calendar put spreads and put flies, but they're beyond what I want to discuss in this course. Here's an example of a bear trend in the spider on the daily chart, and I want to talk about it in two different ways. Let's say you are flat and you see this big bear spike occurring late in the bear trend, and you decide that the market is going down more, and you're correct. That makes sense whenever the trend is this strong. And you decide you want to sell, to go short, but your stop might be above the top of this bear spike. It might be above the most recent lower high. It might even be simply above the beginning of this bear spike. In any case, let's say it's further away than you want to risk, yet you want to participate on the downside. A good alternative is to simply go ahead and buy a put. You can wait for a pullback and buy the put at the market, or you can wait to see if the market trades below the low of the prior bar, and at this point buy a put. If you buy a put here and the market goes up here, that's $2 on the spider. You might be very nervous if you shorted the spider, but if you bought an at-the-money put, maybe you paid $2 for it here. At this point, it might be down to $1, but your risk is still $2. Even if the put goes to zero, you lose no more than $2, and it allows you to hold on. And at this point, you might be able to exit your put for $3 and have a $1 profit. You might not be comfortable emotionally had you shorted here, the spider, if the market ran up, $1 or $2 above your entry price. But the put is a good alternative to that. The other alternative is that I was talking about is, instead of being flat down here and then wanting to get short, let's say you were short from up here and now the market's down here, and you think, gosh, my stop has to be above the bear spike or above the lower high, and that's far more than I want to risk. Let's say it's 5 times more than I want to risk. You can reduce your position size to a 20% size, but if the position size is so small that you don't want to continue to hold, you can replace your stock position, your short spider position, with a put. So you simply buy back your stock for a profit. If you sold it up here, you have a big profit, and you can then go ahead and buy a put or a put spread to try to capture any additional gain that the market might offer you. Understanding breakouts and how to trade them is one of the most important skills you can develop as a trader. Breakouts, when strong and successful, usually have a second leg. So in other words, once the market breaks out, there's a pullback and then a second leg. And they often go for some kind of a measured move based upon the size of the spike or the size of the trading range from which they broke out. And breakouts often fail. And traders all the time have to decide what to do once they see a big breakout. So for example, if there's a news report or an earnings report on a stock, and the stock opens with a big gap up, you'll hear traders on television like Fast Money on CNBC. I don't get any money from Fast Money. I'm just mentioning them because it's a popular show. You'll hear the traders say, big gap up on news, do we sell it? And you're saying, wait a minute, why are they talking about selling a big gap up? Shouldn't they only be talking about buying? Not necessarily. They'll look at the big picture. They look at all the bars to the left. If the market is in a very strong bear trend, they'll assume that the breakout is just a buy vacuum up to test resistance, like maybe the top of a channel, and they'll look to sell. You'll also have other traders who'll say, big gap up, maybe it'll break out above the bear channel if it's in a bear trend. What a great opportunity to buy on strength, expecting follow-through buying. And neither the bulls nor the bears are all that certain. Remember, the 60-40 rule, most of the time the probability is between 60 and 40%. And that is really true. Anytime the market gaps up big, the market's trading, there will be institutions buying and other institutions selling. And you have to assume that both the bulls and the bears are profitable. Most institutions are. And how can both a bull make money buying and a bear make money selling at the same time? It's because of trade management. If they look at the big gap up, they'll say, I don't know, maybe 50-50 chance it'll go up or down. They will have to risk half of what they're going for in terms of reward. They'll have to decide where the protective stop is, and they'll have to go for a reward at least twice as big. They don't specifically say, oh, what do I need to get a positive trader's equation? How big a reward do I need for a positive trader's equation? And that's not what they do. They look at worst case stop, and then initially they'll go for a target twice that size. If the market starts to go their way without getting anywhere near their stop, they'll take a look at how far the market went against them before it started to resume in their direction. At that point, they'll base a target on the actual amount of money that they had to risk on the trade. One thing you'll never hear traders say is, oh, it gapped up and now it has a hanging man pattern or a dark cloud cover. Okay? Traders are not interested in that stuff. It's nice, right, to have a signal bar. It's much more important to have context. Where are you in the market cycle, and is the market at support or resistance? That is the overwhelmingly most important thing that you need to know as far as taking trades. And then next, you have to know how to manage your trades. For example, when you take the trade, if you're very confident that the trade is good and that there'll be follow-through, chances are it will not go very far. So you probably have to scalp more, swing less, and go for a smaller target, maybe 1 times your risk. On the other hand, as is the case most of the time, you look at the chart and say, oh, I don't know, maybe it'll keep going, maybe it'll reverse. Okay, when that's the case, you should go for a reward at least 2 times bigger than your risk. So when you see the market gap up or down on a report, remember, there are institutions who will buy that gap, and there'll be other institutions who will sell that gap. Both, if they see this identical trade 10 times, will be profitable because of their trade management. And it will have nothing to do with the doji bar or the candlestick pattern or any other thing in terms of reversal patterns or continuation patterns on candlesticks. Let me give you an example. Here's Nike, daily chart of Nike, and it was in a bear trend. Not a strong bear trend. It's a channel. Channels are weak bear trends. Lower highs, lower lows, and then it gapped down big on a news report. I think it was an earnings report. And you look at perfect doji star, a very big bar with a perfect close right in the middle, no body. So candlestick traders get excited. Oh, wow, a doji star in a bear trend, this could be the end of the bear trend. It can, but if you watched Fast Money or any business show on that day, you did not hear any trader saying, oh, wow, big gap down and a doji star. If it goes above that bar, it's a buy. Nobody said that. What they said was, do you think it's cheap enough to buy? Do you think it's overdone? Do you think it's at support? Do you think the support's below and it has room to go on the downside? That's how traders talk about it. So it's not the doji pattern that they're interested in. They're interested in all the bars to the left. I don't have much on the left here, but in actual fact, this is fairly close to the bottom of a trading range, a support area. And very often, when the market has a big gap, it trades down to the support area, and all of a sudden, bulls appear. And you say, wait a minute, why didn't the bulls prevent the gap from happening? Well, if you're a bull and you think it's going to test support, why buy here if you think it's going to reach here? So they just wait until it gets here, and then the bulls start to buy. And the bears, if they think it's going to get to support, they're going to sell aggressively all the way down. Even if there's a gap, they'll sell the open, expecting it to go down a little bit further. They may only scalp, but they're going to sell. And this is what resulted. The bears probably scalped, bought back the shorts, and that lifted the market up here. And the bulls, when it got down to what they thought was support, they started buying, and it lifted it to here. nobody was talking candlestick patterns. Candlestick patterns are for home traders, people like you and me, and they're part of the setup, but they're not the setup. The setup is the support and the resistance, all the stuff to the left. The signal bar is the doji pattern, but the reality is most institutions are placing bets and they're totally ignoring this bar. They don't care. They just are interested in whether or not the market is down to a support level. And then they place a bet. They take a chance. Here's a common situation where you have a bear breakout where the market flips to always in short. So we have a bear bar, another bear bar, another bear bar, and then a bigger bear bar. So we have a bear bar bigger than the one before and another bear bar and breaking out. We have lower highs, lower lows, right? So at some point traders say, it's a bear channel. It's not just a trading range. And at this point, by the close of this bar, most traders would say, yeah, I think it's always in short. It was pretty good. It was in a bull leg up here and then a pretty good bull leg here. Some buying here, but this strong 4 bear bar spike was enough to make me think that the bears have control and that the market is going lower. When the market's always in short, what do? You got to look to get short. In this particular case, we have an II pattern, a small triangle, and you could short below it, or you can say, I don't know, these bars they're good, and it's enough to make me think we're going lower, but the big picture is that of a weak bear channel, in which case the market will probably bounce, and I should be able to sell higher. But I don't know, maybe it'll accelerate to the downside. So traders can short below this bar, they can short at the market, they can short the close of this bar, right? But we have tails on the bottoms of the bars, so some buying. The bodies are big, but not huge. So the bears are not all that strong. A lot of traders will assume that this bear spike will be followed by a pretty good pullback. And here the market rallied for about 10 or 15 bars. And it in fact formed a low four short in a bear channel. We had a push up here. Okay, so that sets up a low 1. We had a second push up here. Sets up a low 2, did not trigger. Then we had another breakout, a pullback, and a second breakout. So 4 pushes up, that makes it a low 4. You can also argue wedge bear flag, push up here, and then 2, 3, 4. Doesn't matter, sometimes wedges have 4 pushes. In any case, this is probably going to be a bear flag. Traders could short, as I said, the close of the breakout bar. As soon as they decided it was always in short, they could sell there. They could sell below this bear bar. But they're looking for a swing. The market's in a bear trend, and they just decided at this moment that it's in a bear trend. So they're looking for a swing. And where does their stop go? Above the top of the spike. You could put it above the most recent lower high, or above the top of the bear spike. The bear spike began with this bear body. To me, I would probably put it above the top of above the lower high. And once you decide that it's always in short, you keep looking for opportunities to sell until the market becomes always in long. And here we formed a triangle. 3 pushes up. 1, 2, 3. You can call it a triangle. You can call it a tight trading range. You can call it a double top bear flag. It does not matter. But what does matter is it's always in short. It did not become always in long. So the bet is that it's going lower. And you look for reasons to short. And it's better to short below bear bars, but when you have a low 4 setup and always in short market, you can short below a bull bar here. Here we got a bear bar closing on its low after a little rally. It's a sell. Here we have a couple bear bars, and we have a doji bar here. You can sell below these bear bars, another breakout. Bear bar closing on its low after a pullback to the moving average. It's a short. Bear bar closing on its low, relatively big bar. That's a short. Another big bear bar closing on its low. That's a short. Even though it traded up here, it's still a short. And you trail your stops above the most recent lower high. So every time the market goes to a new low, the stop goes above the most recent lower high. So at this point, it fell below a low. So this stop goes down here. Here we broke to a new low. So the stop would move from here down to above this double top. The point of this slide is whenever you have a breakout and the market converts clearly to always in short in the eyes of traders, You can short for any reason, but if the breakout is not all that strong, you have to rely on a protective stop that is above the top of the bear spike, and that sometimes means you'll have a rally that goes on for more bars and covers more points than what you might normally expect. But that's still okay. You decided it's always in short as long as it stays below the top of the bear spike, and as long as it does not clearly become always in long, it's short. And you can keep shorting and you rely on your protective stop. As with any trend, you should try to swing at least part of your position, especially when the trend is very strong, when it's in its breakout phase. If you're trying to scalp, for example, if you're selling closes, looking for scalps, you have to use a tighter stop because you're going for a smaller profit, but make sure that the reward you go for is as big as your risk. Advanced traders can scale in both as the market goes against them and as the market goes in their favor. They can keep selling closes and adding on as the market goes down. Okay, if you have a successful breakout and you look at it and you say, wow, this is going down, then you're 60% sure that it's going down and the probability is high. You have to sell for any reason, even if it's at the market. If you wait for a pullback, you may wait a long time and you may end up missing the best part of the trend. The market is just falling point after point after point after point while you're waiting for that pullback that will allow you in with a smaller risk. You end up missing a huge trend. You're never going to be more than 60% certain, so you can't be paralyzed by the 40% chance that you're wrong. 60% is as good as it gets. And if you're going to be trading as a living and for a living and you see a 60% setup, you have to take it. Even if the risk is big, the stop is far. Trade small and take the trade and rely on the stop. Once you're convinced or strongly believe that the market is always in short, sell at least a small position, right? Just get in the market. And if the market continues your way or if it has a pullback, build your position up to its normal size. I talk more about breakouts and trading strong trends in other modules. So when you're in a strong bear breakout, the spike phase of a bear trend, one way to get in is simply sell the close of the bar. So if you have a bear bar and another bear bar, just sell the close, right? And put your stop above the top of the spike. If there's no pullback and the market falls quickly, 2 points, 3 points in the E-mini, scalp out part or even all, because your actual risk probably was small. When you start to see consecutive strong bear trend bars and the context is good for lower prices, you have to get short. You cannot wait for a pullback because the trend can go a long, long way. Here we have a very large gap up. First bar of the day closing on its low, and then we have two other bars with bear bodies. Here's a second entry short. A pretty good chance that it's a swing short. Possible that this is the high of the day. It's certainly a good looking bar, and the context is good. A very big gap up, far from the moving average. And then when you see this very strong entry bar, had you taken that short, you look at this and you say, well, at a minimum, it should get down to the moving average. When you have a second entry short, both good-looking bear bars, and you have a very strong bear bar breaking far below the low of the opening range. The market is going to go lower. Well, market's going to go lower. That means it's always in short. You sell the close, put a stop above the high. You look and you say, well, that's 5 points away. I don't want to risk that many points in the E-mini. That's okay. Trade 1/3 size, trade 1/4 size, but trade something just to get short. All right, the next bar, what do you see? You see confirmation that the bears are in control. They were obviously in control of that first very big bear bar, and now we have another bar closing on its low, which is the follow-through bar. So we have follow-through selling after the original bear breakout. Well, I would assume the market's going lower. Again, sell the close. All right, so the market went down, but now it's popping up with a tail. It's still always in short. There's no reason to buy here, and that means that there are sellers above. Where's your stop? Probably, to be safe, above the top of this bear breakout bar. The market probably will not get above the high of this bar either. There's a gap here between the low of this bar and the high of that bar. And at the moment, it's a breakout gap, and the gap is starting a bear trend. So I think you can sell this close, but your stop is higher up. You can also sell above the high of the bar, but we're getting a tail and we're near support, the moving average. So I think if you're flat, I would go short, or certainly short any pullback. But if you're already short, I would just hold short. Resumption of the strength. Another breakout bar, close below the low of the prior bar. Yes, it could be a buy vacuum test of the moving average, but to me, it's another strong bear bar, and we're going lower, probably going lower. So if you sell the close, your stop is probably somewhere up here, and just trade small, but make sure to trade. Make sure to get short. 2-bar reversal. So if you sold that close, you have a problem right now. What do? Well, if you're a beginner, you either rely on your stop and take your chances. If you're a more experienced trader, you're going to bet that this is going to have a second leg down after such a strong sell-off, and you're looking to short. You might short above the high of this bar. You might short that bear close. That bull close. Traders who shorted down here at the moving average, they have a problem. Experienced traders, they might not have shorted a close at support, the moving average, but if they did, they probably traded small enough so that they can add on higher and still rely on their initial stop. Better for the bears, a 2-bar reversal sell. We had a 2-bar reversal buy, but the context was bad. We're in a strong bear trend, so the market probably was going to have sellers above the high of any bar. If a trader's flat, I think it's reasonable to short below this, or they could wait. This is strong enough up, these 2 bull bars, so that we might go sideways. And this is what followed. Another bear breakout, another follow-through bar, another bear close, another bear close. Lower low, possible bounce here at the moving average. But through here, certainly sell closes. I usually don't sell closes if the market is at support. The market went sideways to up for the rest of the day, or for the middle third of the day, and then the bear trend resumed later in the day. We had another strong bear breakout. The follow-through bar, a doji. It had the minimum confirmation needed for a bear trend. It did not have a bull body. It was not a bull reversal bar. Next bar, bear body. Next bar, bear body. Yes, tails, so not strong, but still always in short, probably with a stop above the high of this bull bar, maybe a couple ticks above the bottom of this, above the high of this bear bar, maybe a couple ticks above the low of this bull bar. And you can continue to sell closes as long as the market continues to have consecutive bear closes. A big breakout at the end, so now we have consecutive sell climaxes right here, and then slower. Another big bear bar, another climax, and now a third consecutive climax. The market may soon have 10 bars, 2 legs, sideways to up. So I would not sell that close. Also, it looks like we're around a leg 1 equals leg 2 move. The height of this leg looks like it's about the same as the size of this leg. So I probably would not sell that close because I think a lot of bears will look at it as a gift going into the close. Wow, that's unexpected. We have a very big bear bar in a trend that has gone on for a long time, and it's the third consecutive sell climax within the same bear spike. I didn't think it was going to give me that. I'm going to just buy back my shorts. Aggressive bulls will probably buy that close for a scalp up to the moving average. So where do you put your protective stop when the market's in a strong bear breakout? Initially, if you sold below this bar, your stop is above its high. Once you had a huge bear bar, let's say you sold the close, let's say you sold here. At this point, you would move your stop to above the high of the strong bear bar. Another fairly strong bear bar, and there's a gap between this low and that high. Some traders would put their stop just above the top of this bar. It has a strong enough body, plus we have a gap, and the bear should try to keep it open. Once the market started to trade down here, traders would lower their stop to 1 tick above its high. This is basically a double top bear flag. This high and this tail is a small double top. Okay, we're starting to get tails. We've got 2 strong bull bars. We've got more tails, some overlap, a bull reversal bar. The market might be transitioning into a trading range. Once it transitions into a trading range, I'm looking to buy low, sell high, and scalp. And I'm no longer looking to swing, or if I swing, I'll swing very small. This looks like it might be transitioning into a trading range, and so I want to buy low. We're low, so I want to buy. I'm not necessarily going to buy to get long, but I will buy to take profits on my shorts. This is a good location to take profits on shorts. If you shorted this bear spike or any of these bear closes, your initial stop is above the top of the spike, above the high of this bar. Another bear breakout, if you short these closes, your stop now goes above the high of the most recent big bear breakout bar. In the strongest bear trends in the breakout phase, you want to sell low 1 pullbacks during the initial spike down. Once the trend weakens and begins to form a bear channel, you look to sell low 2 pullbacks, 2-legged pullbacks, more complex pullbacks. For example, we have a strong bear spike and then a pause. This is the you could short this as a low 1. You could short this as a low 1. Here, you can argue it's a low 1. You can say bear micro channel, first breakout above the bear micro channel, it should fail, and it's a low 1. Or you can argue it's a double top with this bull bar. Double tops are rarely at the same level, but it is a double top, a push up and then down and another push up. So this is a low 2 short, or you could wait to short below the low of the bear bar. Another bear breakout, so you start the count over again. First pullback, bear signal bar, a low 1 short. We go on further. Another pullback on this bull reversal bar, bear inside bar, another low 1 short. You sell below the low of that bar on a stop, you get filled right over here. Here you can call it a low 1 or a low 2. We have about a 15 bar bear micro channel, 15 consecutive bars or so, without a bar going above the high of the prior bar. So the first time that the market goes above the prior bar, traders will look to short the resumption of the trend. So they'll short 1 tick below the low of that bar. Sometimes in a strong bear trend in the spike phase of a bear, the breakout phase of the bear, there'll be a pullback, maybe a 1 bar pullback, forming a low 1 short. However, sometimes the low 1 short does not quite look right. And when that's the case, you can use your actual risk to set your profit target. If it's unclear whether or not the trade looks good, aim for a target that's 2 times your actual risk. If the probability looks like it's very strong, 60% or better, you can exit with just 1 times your risk, and you will have a profitable trader's equation. If you look at it and it's questionable, then you can only make a profit if you take 100 of these trades. If you're going for a profit twice your risk. Whenever the probability is 40 to 50%, you will not make money unless your average profit on your winners is 2 times your risk. So let's take a look at this bear trend. Okay, trading range up through here, and then a very strong bear breakout. Maybe we'll get a trending trading range day. Maybe this will become a spike and we'll get a channel. So anyway, here's the first pullback, and this is a low 1 short. The first pullback after a breakout, I think, is a fairly high probability trade, and in general, I would go for at least 2 times my risk. So if you sold below the low of that bar, where's your stop? To me, if I'm taking this trade, my stop is going to be above the high of the bear spike, maybe the breakout bar here, or maybe the top of the lower high. So my initial stop is going to be the swing stop up here, and that means I trade it a little bit smaller. On the other hand, if I wanted to just go for a scalp, I could trade my normal position size and put my stop 1 tick above the signal bar, especially since it's a bear body. You can argue on a smaller time frame it's a double top, this tail, and then here. So on a smaller time frame it's a low 2. So if I took it as a scalp with my stop up here, Okay, I think that's a high probability scalp. So technically, I could exit with one-time risk. The trend looks like it will probably get a measured move down from the height of the spike. So it probably, from here to here. So a measured move down would be somewhere here. Realistically, I probably would try to swing part of it. Here we have a potential spike and final flag, 1 bar final flag. The move down here, small bars, tails, starting to get some buying pressure. This is not a strong buy signal, so I would not look to buy. But here we have a bear microchannel, 5 bars down, and a pullback. The market broke out above the bear microchannel on this small bar. Okay, so arguably that's another low one short. So you could short below its low. But where is your stop? Would you put your stop 1 tick above the high of the bar? I would not. When you get a small doji after a doji, too much risk of a tight trading range and the market going up a few ticks, down a few ticks, and going sideways for a long time. So where's your stop at this point if you took this short? To me, the best stop is the swing stop. I think the market went always in short on this bear breakout. And as long as we stay below the most recent lower high, the market's in a bear trend and always in short. But you're saying, well, I don't want to risk, that's like, $1 in the spider. That's right, it is. It's a big risk. So if you take that short and you use the swing stop, you have to trade very small. If the trade quickly goes your way, you take your profit. If, on the other hand, it goes against you, as it did here, it triggered the short below this bar and then immediately reversed up. You would have been stopped out if you put your stop above the high of the signal bar. To me, I would not have put my stop there because, at a minimum, it might come up and test this high. We may try to form a double top bear flag at the moving average. Realistically, it's still on a short as long as it remains below the most recent lower high. So I would not put my stop there. I might put it, a few ticks above this bar because the bears should be able to keep it as a double top and below the moving average. But the ideal stop is either above the start of the bear breakout or a few ticks higher above the bear spike. So your initial stop is up here. Similarly, we have another bear breakout here. Okay, after a series of 4 bars, we broke to the downside. So we have a potential bull flag and double bottom, and instead of breaking to the upside, it broke to the downside. Normally, when the market does the opposite of what is likely, it usually has at least 2 legs. So there's one push, it should have a second push down. And so it's reasonable to short below this bull bar. The bulls see this as a consecutive sell climax, an exhaustive move. There's a sell climax, another one, and then this, and then this. So they see it as an exhaustive sell climax. They see a bottom of a channel through here. So they see a failed breakout below the channel and a reversal up. I personally would not take that long, although it could have been the low of the day and we could have traded up. On the other hand, I'm faced with this low one short. I think the odds are we'll get a second leg down because we should have tried to go more sideways here and instead we broke to the downside. So the lower probability thing happened, and that usually means the market will have a second push. But let's say I took this. My stop is probably several ticks above the high of this bear spike. If we do reverse, the first target is the top of the bear spike. Normally the market goes a tick or 2 above and runs the stops and then enters a trading range. But let's say I took the short here. I could have used either the top of the bear spike or the most recent lower high for my stop. In either case, I'm risking a lot, so if I took this short and I was trying to get some kind of a swing, I got to use the swing stop here or here. And to me, the probability is not all that high at this point because of what I said. It could easily be an exhaustive sell climax and end of the move. I don't have a measured move drawn in here, but this could be a measuring gap. So we have an upper range measuring gap, and this is in the neighborhood of a measured move down from this high to the middle of this gap down here. That's around a measured move. The middle of the gap is from the low of this bar to either the high here or the high here, probably the high here. So from this low to that high, that's the gap. So the middle of the gap is around here. The measured move is from there to the middle of the gap, and you project down, it would come right in this general area. So that is support. So you're buying a failed breakout below a bear trend line. You're shorting a failed bear breakout below a bear channel, which and the market should reverse up. So it's a lower probability trade. So if you take it, you should be shooting for 2 times your initial risk, which is either the swing stop here or the swing stop here. the market continued up for a third push, forming a low 3 short, a wedge bear flag. You could add on to your shorts here. You could add on to your shorts here, assuming your position size is not getting too big. But in any case, initially, until the market starts to resume down, I think you're basing your profit targets on your initial risk, which is up here or up here. And this is what happened next. Okay, the market had a strong bear bar, so you could tighten your stop to 1 tick above its high, or 1 tick above this small wedge top. 3 pushes up. 1, 2, 3. So instead of your initial risk, which was above here, now you know that your actual risk was just 1 tick above the top of the pullback. So as this bear bar closes, you know that your actual risk was to 1 tick above its high. Had you had a stop above that high, and you did not know at the time that the market would turn down at this point, but if you had a stop there, you would not have been stopped out. So the minimum location, the minimum price for your stop, where you would not have been stopped out, turned out to be 1 tick above the high of this bar. So you actually only risked from your entry price 1 tick below this bar right here to 1 tick above this bar, and you knew that by the close of this bar. So you could set your profit target at 1 time risk, 2 times risk. I probably would go for 2 times risk, given that the 1 time risk is too small, given the size of this trend. Okay. But anyway, you could take half off maybe at 2 times risk, move your stop to break even, and try to swing the balance. So you would have exited over here. Similarly over here, when the market started to turn down, we have a bear bar here, we have follow through here. So either on this bar or on that bar, you discovered that the actual risk for your short below here or your short below here was 1 tick above. Well, for your short below here, for sure, it's 1 tick above here. So you entered here, you entered right here, below this bar, and as the market started to turn down, you would not have been stopped out had you had a stop 1 tick above the high of this bar. So you found out that your actual risk was just 1 tick above the high of this bar. Your entry price was 1 tick below this bar. When you took the trade, maybe a 50-50 trade, we may have gone sideways. You could go for a reward equal to 2 times risk. And you'll notice that very often, when the market gets down to 2 times actual risk, you get profit takers, and that's what happened here, right? So you were not alone looking at actual risk. The same with over here. Here's your actual risk, entry price to 1 tick above the biggest pullback, and here's 2 times actual risk, right? And what happened? The market went sideways for 10 bars. That tells you that a lot of traders are doing the same thing. They're looking at actual risk and taking partial profits. And that is the end of my module on trading a strong bear breakout. This is Al Brooks, and this is my price action trading course. This module has to do with trading strong bull channels. Remember the market cycle. The market is either trending or it's in a trading range. And when it's trending, it starts with a breakout, which is a strong trend, and then it transitions into a channel where the market has pullbacks, and then the channel eventually transitions into a trading range. The trading range can break out in either direction, and then the cycle begins all over again with that breakout. Trends have spikes initially and then channels. The spike is the breakout phase, and it's a strong bull trend. And the market is very one-sided. For example, if we're talking about a bull trend, and the bulls are totally in control of the market. Eventually the market starts to have pullbacks, and a channel develops. And the market then is in a weak bull trend, certainly weak compared to the breakout phase. There's some two-sided trading, but it's still a bull trend, so the bulls are still stronger than the bears. But the bears are occasionally in control, and that's what creates an occasional bear bar or an occasional pullback. That's evidence that the bears are in control for those brief periods. How do you know that a channel is present? Whenever you see signs of two-sided trading, the market's in a channel. Channels are always contained between 2 lines, but sometimes it may be difficult to understand what the 2 lines are. So sometimes it's not always easy to see what lines the market is using to create the channel. But if you, with experience, and if you look hard enough, you'll usually be able to find the two most likely lines. The types of channels. A channel is a type of trend, and it's part of a trend, and it's sloped up in a bull, it's sloped down in a bear. A trading range is a channel. It's an entirely horizontal channel. Triangles and wedges are channels. Triangles are mostly sideways. Wedges are either diagonal and sloped up or down. But they're channels because anytime the market can be contained between true lines, it's in a channel. Channels can be very strong, almost as strong as breakouts, or they can be very weak, almost as weak as trading ranges. In a strong channel, there's minimum two-sided trading, and the market's behaving much more like a spike. When you're in a strong channel, only trade in the direction of the trend. And we're talking about bull trends here, so you only want to buy. When it's in a weak channel, and they're very prominent two-sided trading, big swings up and down, you should trade it like a trading range. Buy low, sell high, and scalp. Since it's a bull channel, make sure to buy low to take the longs. Taking the sells at the top of the channel is less important. When you're looking at the market and you cannot decide whether a channel is strong or weak, assume that it is strong and only look to buy. When you're looking at the market and you cannot decide if it's still in the spike phase or if it has transitioned into the channel phase, assume that it's in the breakout phase, in other words, strong, and only look to buy. When channels look like this, very tight, very small pullbacks, they're spikes on higher time frame charts. This is the weekly S&P, the weekly spider. When channels look like this, only look to buy. Don't worry about taking shorts. You won't make money on the shorts because the sell-offs won't drop far enough to make a profit. This is too one-sided and no significant bear strength. Here's the daily spider. When a channel looks like this with very broad swings, very deep pullbacks, you certainly should buy because it's a bull trend, but you can also short as well. When a channel is very tight, it's still a weak trend compared to a breakout, but it can be almost as strong as a breakout. And when it is very strong, you trade it like a breakout and only trade in the direction of the trend. And if you look at a higher time frame chart, that very tight, strong channel is simply a spike on the higher time frame chart. Here we have a gap up and then a couple strong bull trend bars. So the spike is the gap plus the two bull trend bars. And then you can draw two lines that contain the price action. So this is a channel. But look how small the pullbacks are. 1 or 2 bars, and they don't even fall below the prior bar. So this is an extremely strong bull channel. It's a very tight channel. However, it's relatively weak compared to the spike phase. But it's so strong that you should only trade it like a spike, like a breakout, and only look to buy. Again, channels can sometimes be almost as strong as spikes. The channel can be very tight with very small pullbacks and very little two-sided trading, maybe an occasional bear bar. It's still weak compared to a breakout phase, but it's still strong enough so that you should only look to buy. Treat it just like a spike, just like a breakout. Whenever the market's in a strong bull channel, you should look to swing just as you would in any strong bull trend, like a breakout phase. Swinging is better than scalping, and like all channels, it follows a spike. The spike may be small. It may be simply a single bull trend bar. It may be large. It doesn't matter. As long as you see a channel, you know you're in a trend, and you know it's a channel. And if the channel is very tight, try to swing and treat it more like a breakout. When a channel is very tight, if it is a very strong bull channel, it is a spike on a higher time frame. And if you look at the higher time frame chart, you'd only be looking to buy, and you would be expecting the market to go higher. So on the 5-minute chart, you should also only look to buy. So here's an example. 5-minute chart on the left, Same chart on the right, 15-minute chart. We have a gap up on the open, the pink rectangle. Here's that same gap on the 15-minute chart on the right. The green box on the right, it's a wedge-shaped bull channel, but it's very tight and the pullbacks are very small. They don't even fall below the low of the prior bar. This is what that green box looks like on the right. So on the left, it's a 5-minute channel. On the right, it's a series of consecutive bull trend bars on the 15-minute chart, close above the high of the prior bar, so there are gaps all the way up. Every close is above the high of the prior bar, so there's a gap between the close and the high of the prior bar. So this is an extremely strong bull spike, and you should only be buying and buying for any reason. And the same is true with the 5-minute chart. So what are the signs of a strong bull breakout, a spike? Big bull trend bars, consecutive strong bull trend bars, small tails, in other words, bull bars closing on their highs, and no significant selling pressure, no bear bars, no reversals. And the context has to be supportive of higher prices. You don't want it to be a race to the top of a trading range. And how do you diagnose a spike? Well, you just look for big bull bodies, closes near their highs, small tails. Here's a gap, that's part of a spike. We have a series of 3 consecutive bull bars, and there are gaps. The close of this bar is above that high. The close of this bar above that high. Close of this bar above the high. Close of this bar above the high. So the market is gapping up on a lot of the bars. Very little overlap between adjacent bars, and a series of consecutive bull trend bars. So these are very strong bull breakouts. So a gap spike here, a bull spike here, and another bull spike here. These 2 last spikes are within the context of a wedge channel. And what are the signs of a bull channel? In contrast to a breakout, you have pullbacks. They might be small if the channel is strong. There might be an occasional bear bar, some overlap between adjacent bars, some areas of sideways trading, and a lot of the bars will start to develop tails on top of the bars. So the the bar is going up and up and up, and then into the close of the bar, it sells off. So that means the bulls did not control the bar into the close, and that the bears are getting stronger. Also, if the bull channel is made of smaller bars, that's a sign that the bull is not as strong. When the market is in a strong bull channel, you should trade it like a breakout, a spike, a strong bull trend, and try to swing at least part of the position. When you are scalping, use a tight stop and go for a reward that's at least as big as your risk, and more experienced traders will scale in as the market goes against them. You always need to diagnose as early as you can. So here we have a big gap up, a 2-legged move that did not even reach the moving average, a 2-bar reversal, and then 3 strong bull bars closing near their highs. We went sideways here for 5 bars, so maybe we're entering a channel. These bars are getting smaller body, tail on top, so we're probably in a channel phase. But the channel is tight. The distance between the trend line below and the trend channel line above is very small. And the pullbacks are very, very small. It's not even pulling back. So you know that this is a strong bull trend. Well, it's actually a weak bull trend because it's a channel, but it's a very strong channel, and it probably is a spike on a higher time frame chart. So you have to get long. You can't look at this and say, well, 1 push up, 2 pushes up, top of the trend channel line, a wedge top. There's simply not enough selling pressure, and there is too much buying pressure, too many big bull bars. Too many gaps in the bull bars, close above the high of the prior bar, close above the high of the prior bar. You cannot be looking to sell. You can only look to buy. So you can buy for any reason. You can buy the high 2 over here. You can buy closes. So you buy for any reason, and you certainly don't sell. So how do you get long, and where is your stop? Is it time to buy yet? Whenever you look at the market and you're starting to feel agitated, desperately hoping for a pullback, you know the trend is strong. And when that's the case, if you're not long, just buy at the market. Buy at least a small position at the market and use the stop below the bottom of the bull spike. You just determine how far away your protective stop is and try to go for a risk at least as big, and depending on how many ticks you're risking, that determines your position size. If you are having a hard time determining the exact position size, don't worry about being exact. Just instantaneously trade half size or quarter size and buy right now this minute and trust your stop. How can you buy? Lots of ways to buy. Just as with any strong trend, if you're in a strong channel, same thing. You buy at the market. You buy at the close of bull bars. You buy at the close of bear bars. So if the market is in a bull channel and you have a bear bar, you buy its close. You buy above the high of the prior bar. You buy below the prior bar, betting that any reversal attempt will fail. You press bets and you buy breakouts above swing highs. So the market goes up, you have a pullback, place a buy stop one tick above that high and buy again as the trend resumes and goes above the prior high. If you have bull flags, pullbacks, you buy breakouts of the bull flags. If you pull back to the moving average or a trend line, any other kind of support, you buy at support. And you look to take profits at resistance, such as at new highs or reversals down from new highs. Okay, going into the details of that chart, buy at the market, buy at the close of strong bull bars or strong bear trend bars, it doesn't matter. Buy above and below the prior bar. So here's an example. You just buy at the market. The trend's going up, you know it's going up. Buy at the market and buy small. Put a stop below this ledge or a stop below this bull bar or a stop below this bar. Whichever stop you choose, make sure to trade small enough so that your risk is not too big. We're getting a series of strong bull bars. Buy at the close of the strong bull bar. We have a little pullback. Buy above the high of this bull pullback, betting on higher up. We have a bear close. That's an attempt to reverse the market. Buy the close of the bear because the attempt will probably fail. The market's trying to reverse here. Context is not good. Prior pullbacks are very small. This will probably fail. Place a limit order to buy at its low and get filled as soon as the market moves one tick below its low. You don't have to take all of these, but make sure to take at least one of these. You don't want to sit without any position at all, hoping for a pullback that never comes and then missing a trend like this. Okay, isn't it sometimes better to wait? Well, it always feels like the market's forcing you to buy too high at the top of a channel that just keeps growing up. And it feels that way because it is. Traders are always afraid that a big pullback could come any time. Maybe we're having a buy climax. Well, you are having a buy climax, but that doesn't mean the market will reverse. A lot of times it'll have a series of buy climaxes. And when the trend is strong, you have to get long. The setups, they never quite look good enough. You know it's a bull trend, and therefore you believe there's a 60% chance that the market will go higher, yet it never feels 60% certain. You still have to take the trades. You look at it and you say you think it's going higher. That means you're 60% certain. Trade it like a 60% trade. Figure out where your stop is. Take a position size that's appropriate for that stop. Place a profit target equal to the same number of ticks as you have in your stop, and then exit when the market gets up to your target. If your actual risk is less, you can go for a smaller target. You'll never be more than 60% certain, but don't be paralyzed by the 40% chance that you'll lose. You are going to lose. You're going to lose 40% of the time, even if you're a good trader. But 60%, that's as good as it gets. And if you're going to trade for a living, you have to trade. Okay, so setups never look quite good enough. You can buy closes. You know it's going up. You look at this and say, well, I don't know. Even if it pulls back down here, it's still going up. Well, if it pulls back down here, is it still going up? Probably not. And therefore, somewhere below this bar, you'd say, it's probably not going up. So that's where you put your stop. Below here, below this entry bar, below this breakout bar, below this ledge. Pick whichever one you want. The tighter your stop, the more likely you'll get stopped out. But when you look at this, you know that the one thing you know is if it gets below this low, the low of the day, it probably will not go up further. So worst case scenario is you put your stop here, calculate how many points you have to risk, and then trade small enough so that you can rely on the stop. If the market just quickly goes up 2 or 3 points and you're able to take 2 or 3 points out, take at least half off. If it's going up slowly, you might take all of it off. So if the trend is weaker, you might take more of it off. Okay, so now we got another trend bar. And now we got another breakout and a bunch of dojis, so we're entering into a tight trading range. 3 pushes up, we have a push, and then here's the second push, and then the third push, these 2 bars. So is it a wedge top, and should we expect a correction back down here or here? The channel up is so tight that I would never look to short. We have 3 pushes down, 1 push down here, second push here, third push here, so it's a triangle and a bull trend. Could very well be a bull flag. I think it's reasonable to buy above that high, or you could wait to see if we get a pullback to the moving average. We got a bull reversal bar for the triangle buy setup, which is good. So you could buy 1 tick above the high of this bull bar. Bear is trying to reverse, and the market ticked 1 tick below the high of that bear reversal bar. To me, I think you can scalp out of your longs, but way too much buying pressure, and the channel is way too tight, and the pullbacks have been way too small to be thinking about taking any shorts. Another bull bar, so probably going higher. Okay, now we've entered a tight trading range. So the market has transitioned. It was in a strong bull trend, and now it's transitioning into a trading range. Once you think the market is always in long, in other words, once you see the breakout and you say, yeah, I think this is going higher and I'm worried that I'm flat, buy at least a small position. You can see the modules on breakouts and trading strong trends to get more information about different ways to enter. Again, I mentioned earlier, you can press bets. You can buy breakouts above prior highs. So if the market is up here and it pulls back, you can buy as the pullback resumes up. But if you miss that, you can always buy on a stop at 1 tick above the prior high. Also buy any small pullback, any bull flag. This is an example of pressing your bets. We have a swing high, market pulled back. If you don't buy above this bear bar or this bull bar, you can place a buy stop 1 tick above the prior high to get long. You can buy at the market as a pullback is forming. We have this bear reversal bar, but the context is bad. This entry bar is bad. The follow through is bad. You can simply buy at the market, betting that the top is not going to succeed. You can buy a breakout of a bull flag. Here we have a triangle, 3 pushes down, 1, 2, 3, and we have a bull signal bar. Buy 1 tick above the high of the bull bar, betting that the pullback will end and the trend will resume. You should also look to buy at support, and you should also consider taking profits at new highs and at resistance. What's an example of support? A trend line is a good example of support. So traders will buy at the trend line or just a tick or so below. They'll also buy at the moving average. Despite the strong bear bar, they'll bet that the breakout attempt by the bears will fail, just like all the prior breakout attempts by the bears failed. And where do you put your protective stops when you're swinging? You put them below the most recent higher low. It's as long as the market continues to make higher lows and higher highs, the market's in a bull trend and your premise is still good. If it falls below the most recent higher low, that's a problem. That means it's no longer in a strong bull trend and your premise is wrong. And if your premise is wrong, you get out. So that's a good location for a stop. When you're scalping, you're not going to allow pullbacks. You might allow a tick or two pullback, but for the most part, you do not allow pullbacks. If you have a strong trend bar or up or a strong trend bar down, either one, get out below the low of the strong trend bar. So let's say you bought this close, this green box, right? You could put your stop below the low of the bar because it's a breakout bar. You could also put it below the low of the most recent higher low. That is a better stop but it's a wider stop, and wider stop means higher probability of success, but when you lose more ticks. Both are valid approaches. Let's say you bought here at the close, or for any reason, above the high of this outside up bar, above the high of this bear reversal bar after it triggered in shorts. You can use a tight protective stop below the low of the bear breakout bar, or you can use a wider stop below the low of the most recent higher low. Same thing, the wider the stop, the more likely you'll have a profitable trade, the less likely you'll get stopped out. But when you do get stopped out, you'll lose a little bit more money. And that's okay. Both ways are okay. The market transitioned into a trading range, so you stop trading it like a bull trend. It's now a trading range. You trade it like a trading range. You buy low, you sell high, and you scalp. I don't feel that it's as necessary to worry a lot about taking the shorts because we're still in a bull trend, but I definitely would try to take the longs. Okay, IOI here, bull bar here, breakout pullback here, small breakout pullback here, outside up here. Maybe buying above that bear bar. I don't know. Okay, strong bull trend. Only look to buy. You can say, well, Al, this is a trading range, and this is a buy vacuum test of the top of the trading range, and here's a low 1, and here's a low 2. I'm going to short. I would not. To me, we had a bear trend, a break above the bear trend line, a test of the low, and a reversal up. This is a lower low, major trend reversal. We have a low, a lower low, and a lower low. We have a high and a higher high. This is an expanding triangle also. So that's a pretty reliable buy setup. And we have a strong bull microchannel with 7 bars up, and then a breakout with 3 very strong bull bars. To me, you have a terrible signal bar for the bears, especially given the strength of these 3 bull bars. So probably buyers below. And then we have a low 2 short here, but again after a bull bar, and we've only had 2 small bull bars in the past 10 or 15 bars. That's not enough selling pressure to justify a short, especially when you have a bull bar for your signal bar for the short. So low 1s and low 2s are only in bear trends, not bull trends, or they're in trading ranges. And this appears to me to be a major trend reversal and not a trading range. So this is not a low 1 and this is not a low 2, and I would not be taking these shorts. Strong trend, especially after these bars, I think it's better to only look to buy. And that's the end of my module on trading strong bull channels. This is Al Brooks, and this is my price action trading course. This module is about trading strong bear channels. Remember the market cycle. The market is either in a trend or in a trading range. If it's in a trend, it's either in the initial phases, the breakout phase, the spike phase, or it's transitioned into a channel where there are some pullbacks. The channel evolves into a trading range. The trading range then breaks out in either direction, and then the process begins over. In a bear trend, the bear begins with a spike. Sometimes it's a single unremarkable bear trend bar. Sometimes it's a series of bear trend bars. The spike, breakout, same words for the same thing. Strong bear trend, again, all 3 are synonymous. The bears control the market, and the market's very one-sided. When the market transitions into the channel phase, it's a weak bear trend. Sometimes it's still very strong, but it's weak compared to the breakout phase. There is some two-sided trading and occasional pullbacks. The bulls are occasionally in control, and when they are, that creates an occasional bull bar or pullback. How do you know that the market is in a channel? Whenever the market can be contained within 2 lines, it's in a channel. So whenever there's any two-sided trading present, there's a channel. It doesn't matter if you can see how to draw the lines. The market is in a channel. Types of channels. A channel is part of a trend. It's the weaker part of a trend after the breakout phase. It's sloped up in a bull, down in a bear, and in a trading range it's horizontal. And triangles and wedges, they're also channels. When the three-push pattern, the triangle is horizontal, it's a triangle. When the triangle is sloped up or down, it's a wedge. Bear channels can be strong or weak. A strong channel, minimum two-sided trading, it behaves much more like a spike, and you should only trade in the direction of the trend. You should only short when you have a strong bear channel, a very tight bear channel. When the channel is weaker and it has big swings up and down, but it's still forming lower highs and lower lows, two-sided trading is prominent. It's very similar to a trading range that has a slight slope to it, and you should trade it like a trading range. Buy low, sell high, and scalp. When you're having a hard time deciding whether the channel is weak or strong, assume that it is strong and only trade in the direction of the channel. A bear channel, only look to sell. If you can't decide whether or not the market's still in the spike phase or if it's in a strong bear channel, assume it's a breakout, a spike, and only look to sell. When a channel looks like this, very tight, the lines are close together, the pullbacks don't go very high up, impossible to make a profit buying, you should only look to sell. So only when you get pullbacks up near the top of the channel, you look to sell. This is very one-sided, not much bull strength. On the other hand, when you look at this on the right, this is the daily euro versus the dollar, Forex. It's forming lower highs and lower lows, so it's a bear trend, and the swings are broad, so it's a channel, but it's almost like a trading range that has a slight slope to it. You should trade it like a trading range, and buy low, sell high, and scalp. When a bear channel is very tight with very small pullbacks, it's basically like a breakout, and in fact it is a spike, a breakout on a higher time frame chart, and it can be almost as strong as a breakout. When that's the case, trade it like a breakout and only look to short. So when a channel is very tight like this, the pullbacks are very small, I don't care that there's a strong bull reversal bar here. The channel is very tight, only look to sell. Here we had a small spike, a 2-bar, 3-bar spike, a pullback, and then a very tight channel. But the channel is so tight, it's very one-sided. On a higher time frame chart, I'm sure it's a breakout. Like on a 15-minute chart, it's probably a series of bear bars. You got to look to sell for any reason and treat it like a breakout phase of a strong bear trend. Channels sometimes can be almost as strong as spikes. Again, when the channels are very tight, the pullbacks are very small, the lines are close together. There might be some two-sided trading, like an occasional bull bar or an occasional doji, but it's very little. For the most part, it's one-sided. The bears are in control. It's still weak compared to a breakout, but it's so strong that you should treat it like a breakout and only look to sell. The stronger the bear channel is, the better it is to swing than to scalp. And like all channels, a strong bear channel follows a spike, and if the channel is very strong, very tight, it is a spike on a higher time frame chart. So it's a strong trend on a higher time frame chart. Only look to sell. So what are some of the signs of a bear breakout, a spike? You want to see one or more big bear trend bars, big bodies, preferably consecutive big bear bars, closing on their lows, very small tails below or no tails below, no sign of buying pressure, and you want the context to be supportive of lower prices. For example, you don't want this to be 2 or 3 consecutive bear bars inside of a trading range, because it could simply be a sell vacuum test of the bottom of the trading range, in which case a reversal is more likely than a breakout. Signs that the market's in a bear channel: you have pullbacks, you have some bull bars, you have overlap between adjacent bars, the market sometimes goes sideways, and you sometimes have bars with tails on the bottom, showing that they bought the bar into the close of the bar. Also, instead of very big bear bars, you tend to have smaller bars, small bull bars and small bear bars. When the channel is very strong, try to swing at least part of the position. When you are scalping, you use a very tight stop. However, you still want the reward at least as big as your risk. Advanced traders, they can scale in. So if the market's going down in a very tight channel, advanced traders will scale in on pullbacks when the market's going against them. They'll also scale in as the market goes with them. They'll sell this close, they'll sell that close, they'll sell that close. It's good if you can diagnose the situation early. We have a trading range. It's still a trading range over here, but we're forming lower highs all the way down, and now we're starting to get lower lows. We have a low here, and over here we have a lower low. We have a bear breakout, so we have to think about the possibility that the market may enter a channel phase. We have another bear breakout, so again we might be entering a channel phase, and the market is failing at the moving average. It was below the moving average for about 10 bars. Tried to break strongly above it, immediately had a bear reversal. Tried to get above the moving average here, big tail, reversal. Tried to get above it here, tail. Tried to get above it here, tail. So the market is probably in a bear trend. It does not look like a strong trend because we have pullbacks along the way. So if it's not a strong trend, it's a weak trend. If it's a weak trend, it's a channel. Start looking for ways to draw channel lines. Every time you see a new swing low, you connect it with a prior swing low. Every time you see a swing high, connect it with a prior swing high. All right, so how do you sell? How do you get short? Where's your protective stop? Okay, is it time to sell? If ever you feel agitated and you're desperately hoping for a pullback that will allow you to sell using a smaller stop, then don't wait for the pullback. Sell. That tells you that you know that the trend is very strong and you must sell now. Sell at least a small position at the market. Figure out how far your stop is. You look at it and say, wow, that's a lot further away than I want to risk. Well, it's not. You just trade very small and that is your stop, no matter how far away it is. So you determine where the protective stop belongs. From there, you figure out what size position you should be trading. If your stop is 3 times bigger than average, trade 1/3 as big as average. And then sell right now, at this minute, at the close of the bar, as the bar is forming. It doesn't matter. You've got to get short at least a partial position and rely on your stop. So how do you short in a tight bear channel, a strong bear channel? The same as you do in any strong bear trend. You sell at the market. You sell at the close of strong bull bars because they are attempts to reverse the bear trend, and 80% of reversal attempts will fail. You sell on the close of every strong bear bar because that's an attempt to resume the trend, and it probably will succeed. You sell below bars, below the prior bar, because you're betting that the trend is resuming. You sell above bars because, again, it's an attempt to reverse the trend, and it probably will fail. You press your bets, and you sell breakouts below prior lows. Anytime you get a small pullback, you sell that as it's beginning to resume back in the direction of the trend. So you're selling breakouts of bear flags. You sell at resistance. If the market comes up to the moving average or a trend line, you sell. If it comes back to a prior spike bottom, you sell. And you take profits at new lows and at support. So how do you sell? Initially, if you're convinced the market's going lower, you just sell something at the market. Determine how far your protective stop has to be, and then adjust your position size so that you're still trading within your comfort zone and you're not risking too many dollars. So for example here, you got a bear breakout, a close below the low of the prior bar. Just sell at the market. And you can say, well, where do I put my stop? Well, worst case is you put it above the most recent lower high. We're starting to form lower highs, so we're trending down. You could also put it simply above the high of this bear breakout bar. You can sell at the close of any strong bull bar, betting that the reversal attempt will fail. You can sell at the close of any strong bear trend bar, betting that it's a resumption of the trend and it will succeed. You can sell below bars and above the prior bar. So for example, strong bear bar, sell the close. Bear bar, sell the close. A strong bull bar, sell the close. And put a stop above the most recent lower high, betting that the market will continue to channel down and form a series of lower highs. Sell below the prior bar. So when this bar forms, put a stop to sell below it. Doesn't get filled on this bar, put the stop below this bar. Doesn't get filled, put a sell stop one tick below the low of this bar. You finally get filled. You sell above the high of the prior bar, betting that any reversal attempt will fail. Here is your stop at this point, maybe above here. So you trade small enough so that the total dollars that you're risking is no bigger than when you normally are trading. You can press your bets and sell breakouts below prior swing lows. You can sell small pullbacks. You can sell breakouts from bear flags. The market is falling below a prior low, sell. Here's a prior low, here's a prior low, market broke below. You sell on a stop, one tick below here, one tick below there. We have a prior low, an attempt to reverse. You place a sell stop one tick below this bar or one tick below this bar. You sell pullbacks. You can have a fixed number of pullbacks, fixed number of points. Like you might sell 5 ticks or 10 ticks or 15 ticks above the most recent low. You can sell breakouts of bear flags here and here, here. You keep redrawing the channel lines every time the market makes new lows and new highs, and the channels tend to get flatter and broader, okay, as the two-sided trading increases, and eventually the market evolves into a trading range. And once it does, then you trade it like a trading range. Other ways to sell, you can sell at resistance, and you can take profits at new lows and at support. Isn't it better to wait? It always feels like the market's forcing you to sell too low, and that a big reversal or a big pullback can come at any time. It doesn't matter. You live in uncertainty when you trade. You're never going to be certain, and you just rely on your systems. You decide where you are in the market cycle, and then use the trading approach that's appropriate for where you are in the market cycle. Again, the setups never look very good. However, you know it's a bear trend, and therefore you believe there's a 60% chance of lower prices. It never feels like 60%, but if you believe the market is going down, assume that the probability is 60%. You'll never be more than 60% certain, because traders always live between 60% and 40%, and never be paralyzed by the 40% chance of a loss. That's part of doing business. 60%, it doesn't get better than that as a trader. And if you're a trader, trade. Take the trade. Take the short. So you sell at resistance. Top of the channel. Near the top of the channel, look to sell, either at the channel or as the market reverses down. Near the moving average, either sell near the moving average or sell as the market reverses down. And again here. As the market becomes more two-sided, you use new lows to take profits. Market falls below this bar. Let's say you shorted up here or you shorted here. You take profits either at a limit order at the prior low or as the market reverses up. Where are your protective stops? As long as the market continues to form lower highs, it's still in a bear trend. And if you're swinging, you're believing the market's in a bear trend. So if it goes above the most recent lower high, your premise is wrong. So you should put your stops, trail your stops above the most recent lower high. Every time the market makes a new low, lower your stop to the most recent, one tick above the most recent lower high. When you're scalping in a strong bear channel, you don't want to allow pullbacks, and you get out immediately above any bull bar or even any strong bear bar. So let's say you shorted either here or here, okay? If you begin selling this close, for example, your initial stop is above the most recent lower high, which is up here. This bar is such a big, strong bear trend bar, you possibly could put your stop just above it, but this is just a little bit higher. I probably would choose above the most recent lower high. So you short, let's say you short that close, so you get filled right here. You could put your stop way up here. That would increase the chances that you'll have a profitable trade, but because you're risking more, you'd have to trade much smaller. Most traders would just short here and either put their stop here or here. Okay, the market breaks below a prior low, then move your stop down to above the most recent lower high. Every time the market goes to a new low, you raise your stop to the most recent lower high. At some point, you have to take profits, so you look for reasons to exit after your reward is at least twice the size of your risk. You can place a limit order at twice the size of your risk and exit with your limit order, or you can trade from any reversal up from a bear breakout of the channel. So if you have a bear channel and it breaks to the downside and it starts to reverse up, you can exit. You can also take profits at measured move projections or other types of support. So for example, the market's trying to form a little trading range here. Always come up with measured move projections because they're potentially areas of support. Here we have a measuring gap. This high stayed below these lows, so it's possible that this pink line is a measuring gap and the middle of a move. Here's the start of the move, here's the possible measuring gap, here's the projection for the measured move down. So that's a logical place to take profits. You draw trend channel lines below the lows. That's down here, so we're starting to get an accumulation of support in this general price area, so it's probably going to lead to profit taking. We have a trend channel line here, and then a big bear breakout, the biggest bear bar of the past 20 or 30 bars. So it could be an exhaustive sell climax, and it could be an exhaustion gap. The close is below the low of the prior bar, so it's a gap. Then we have a strong reversal up, and it closes that gap. So this is probably a sell climax, an exhaustive sell climax, and the market will probably have 10 bars and 2 legs at a minimum, sideways to up. So you might exit above the high of this bar. You might exit above the high of this bar. The market might be always in long here, so you could exit there as well. And that is the end of my module on trading strong bear channels. This is Al Brooks, and this is my price action trading course, my module on trading weak bull channels. Is a channel weak or strong? Take a look at the module on channels. Let's talk about a bull channel. Is it weak or strong? Sometimes it's impossible to tell, but it does not matter. If you cannot tell, only look to buy. Weak bull channel. Bull implies trend, which means higher highs and lows. Channel implies weak trend, and it occurs after the breakout phase. The weaker the channel is, the more likely you can take trades in both directions and make a profit. Weak channels tend to have broad swings, which means a lot of two-sided trading. If it's reasonably strong and reasonably tight, only look to buy. Only take trades in the direction of the trend, and don't worry about missing the sell signals. Is the channel so broad and so flat that it's actually a trading range? A lot of times it's impossible to tell, and a lot of times it's actually both a channel and a trading range. And it doesn't matter because you trade them the same. You buy low, you sell high, and you scalp. Most weak channels begin as trading ranges. So for example, here we have a trading range. Okay. You could also argue that it's a bear channel. We're forming lower highs and we had lower lows. And you can also argue that it's a bull channel because we now have a higher low. So it's a bull channel, it's a bear channel, and it's a trading range. It's a triangle. 3 pushes up, 1, 2, 3. Again, here is the triangle, and you could look at this as a bull channel or a bear channel. And right now it's both. It'll stop being one before long, but right now it's a bull channel, a bear channel, and a trading range. We have a bear spike, and you can argue that we have a bear channel. We have a lower high, possible lower low, and it's possible that this will end up in a channel. You take this line, you draw a parallel, and you anchor it here or you anchor it here, and that could be the start of a bear channel. So you can envision how this could unfold as a bear channel. But you can also look at it as a possible bull channel. We have a low and then a higher low. You take a parallel of this and anchor it up here, and this could be the start of a bull channel. And at the moment, we don't know which it is. Incidentally, you get a bear channel, a trend line break, and a higher low. So right now, this is a higher low major trend reversal. So it's a swing long. However, it still could continue down as a bear channel. Same chart, and this is later in the day, and you can see what happened. We had the bear channel, the trend line break, the 2-bar reversal for the higher low, 2 big bear bars, so we needed a second entry, and they got it here. The market went always in long during this series of bull bars, maybe here or here. We finally have a higher high, and now we're starting to get a series of higher lows. So somewhere in here, it became clear to traders, especially here, that the market was in a bull trend. And so even though it was in a bear channel, and it was in a trading range, and it was in a bull channel, now it's only in a bull trend. So what do you need to see to think of a channel as a weak bull channel? Well, first of all, you need higher highs and lows to have the bull trend. And for the channel, you need big swings. You'd like to see signs of two-sided trading, signs of selling pressure in addition to the bulls being in control. So overlapping bars, weak follow-through after bull bars. So a bull bar and then a bear bar, a bull trend bar and then maybe another bear bar. Many bars with tails on the top, some selling pressure showing that the bears are still active. You want to see selling into the close of some of the bars, creating tails on the tops of the bars. You'll see bars with bear bodies. So the market goes up and then it goes down for a bar or two. And you have obvious pullbacks, often with big swings. So sometimes it goes up a lot and sometimes it comes down almost as much. And it can have very, very broad swings. And it can end up looking like a trading range that is slightly tilted up. That's still a bull channel, but if it's that similar to a trading range, you can trade it like a trading range. Alright, at this point, what's going on? We have a 3-bar bull spike, a bear bar, a bull spike, some sideways, and another bull spike. So we have a strong bull spike, and now we're starting to get some selling pressure, so we may be in the process of transitioning into a channel. Okay, so strong bull spike here, less strong here, but within here we have sideways bars, we have some bear bars, we have a pullback below the low of the prior bar, we have a bull bar immediately followed by a bear bar, and we have some tails on the tops of bars. So we're starting to get moderate two-sided trading in here, and that's the hallmark of a channel. This is what followed. We've been in a trading range for about 20 bars, a 2-hour trading range, after a strong bull breakout, and it's probably either going to be a spike and bull channel day, or it may be a trending trading range day. We had a trading range here, a breakout, and we're forming another trading range here. This breakout is strong enough so that I think it favors more up. I think the market's always in long and probably strong to go higher. So what do? It's in a trading range for 2 hours, so you can buy low, sell high, and scalp, or you can swing part and bet that you'll get trend resumption later in the day. At this point, you have a push down and then a second push down, so you have a high 2 buy. You also have a double bottom with earlier in the day, and that also constitutes a high 2 buy. And now we have a 2-bar reversal, did not trigger, and then we have a bull bar closing on its high. We're in the bottom half of the trading range buy low, sell high, and scalp. We're low. We've been trading down for about 20 bars. You have to be looking to buy. And you have a decent enough signal bar after a 2-legged pullback. So this is a reasonable buy. So let's say you place a buy stop to go long 1 tick above the high of this small bull reversal bar. You'd get filled near the high of this bar. this is what followed. You got 5 bull bars here, a pause, and then a bull breakout to a new high with follow through there. So pretty good strength. So we have a bull breakout and 2 bars of follow through, and that's a sign of buying pressure. The bars are small, so the bulls are not all that strong, and we have tails on the top, so we have some selling pressure. Maybe we're going to enter another trading range, but at this point, it's a trend. It's a bull trend day. We just don't know what kind. Is it going to be a spike and channel, or is it going to be a trending trading range day, a lower range, another range, and maybe another range? All right. So we have another trading range here, a tight trading range at this point. Within it, we have a double bottom here and here, 2 pushes down, so that's a high 2 buy. And we have a 2-bar reversal here, so traders probably can buy on a stop at 1 tick above the high of this bar. Most of the trading for this past 3 hours has been sideways. If you take out this bar from the picture, pretty much the entire trading for 3 hours now has been sideways. We're just above the moving average. The prior pullback had 5 bars at the moving average. Pullbacks tend to get bigger and deeper, so chances are this will get down to the moving average. We have another bull breakout, but immediately reversed by a 2-bar reversal. So we have a spike up and 3 pushes, 1 being the spike, and then 2 and 3. Now we have a 2-bar reversal. And we probably will have to get down to the moving average because we did here. And you can draw this as a wedge top or a wedge channel after a spike. We'll probably get 10 bars to 2 legs sideways to down. We may find buyers here just above this gap. The market may instead come all the way down here to the bottom of the original channel. All right, we probably should get 2 legs sideways to down based upon the wedge top. You can argue we had 2 legs, 1 and 2, right? But it's only 4 bars. Yet the legs within the wedge itself were, each had 10 bars or so. So this does not look like enough of a correction after this big of a wedge. The correction looks too small. This looks like too small for a 2-legged correction. But you got 2 strong bull bars closing on their high. And to me, you're in a bull trend, and the market's trying to resume the trend, is trying to make the breakout fail. I certainly would get out of my shorts. Had I shorted this, I would have gotten out at break even or above this bear bar, maybe above this bull bar for a 2-bar reversal, or at the close of this bar for sure. Okay, I would get out either with a small loss or around break even. And this is what we have now. Okay, we have a bull spike with 3 small pushes up. 1, 2, 3. Push up and then down. Up and then down. Up and then down. We have a 2-bar reversal and a second entry short. Traders could short at 1 tick below the low of this bear bar. On the other hand, you can look at it and say, I don't know. We have a lot of bull bars all day long, and we're channeling up. We're forming higher highs and higher lows. Yes, this fell below that low, but to me that's not important. I don't think this was a major low. I think this is a more important low. This is just a tight trading range. Okay. Whenever a wedge fails, okay, a wedge, you should always look for 2 legs sideways to down. But as soon as the market got above its high, the wedge has failed. So the odds favored 2 legs sideways to down, and that means was less likely we got the breakout above the wedge. Anytime the lower probability event happens, you usually get a second leg. So we'll probably get a second push up. So I personally would not take this short, especially because these 2 bull bars are strong. We have another strong bull bar here. We have a lot of buying pressure here and a lot here. I would need, you can argue it's a high major trend reversal. We have a trend line, a bear break below the trend line, and then a rally. But the bear break was only 4 bars, and I think that's not enough selling pressure to erase the bullishness of the past 40 or 50 bars. So yes, higher high major trend reversal, second entry on the wedge. I would not take the short. And right now we have a triangle, 3 pushes down. first push down here or here, either of those bear bars. Second push, third push. To me, this is a breakout mode situation, and now we have a bull inside bar, IOI. To me, that's a reasonable bull flag buy for at least one more push up. It's a triangle, so it's a tight trading range, and it's occurring late in a bull trend, so it may end up being the final flag of the bull trend. And we traded up. This time the channel is getting, we have a new channel, and we're getting small bars, some bear bars, more small bars, a bear reversal bar, a breakout trapped bulls who bought above that, another bear reversal bar. I would certainly get out of any longs, and this one I probably would consider shorting. We're starting to get a much weaker rally here. You can argue this is 2 legs up from the breakout above the wedge. You can say this is the first leg up and a pullback, and then that's the second leg up. You have okay, so I think this is a pretty reliable sell signal. We're starting to accumulate selling pressure. The triangle, tight trading range, is a magnet. I think the odds are we'll get pulled back at least to the triangle, and we have a decent signal bar. Okay, you can redraw the wedge and say that this is a larger wedge. Spike, 3 pushes, 1, 2, and 3. And then within this, there's a smaller wedge. The bears who shorted here, their stops are probably above the signal bar high. Some might get out above the entry bar because of the big tail, but I think it's probably better to have your stop above the signal bar. I'm concerned about this short. We haven't had big pullbacks at all today. It's many types of days. You can call it a spike and channel bull trend day. You can call it a trending trading range day. You can call it a wedge top, but I'm concerned that the pullbacks are not very big. And if I take this short, I want the market to fall very quickly, and that's not what it's doing. I personally would get out probably around break even in here. We're at the end of the day, and I want the market to fall quickly. I don't want to see these small bars and tails at the bottom, especially since we haven't really had a trend line break, and we haven't had significant selling pressure, certainly since right here. To me, this is not turning out the way I wanted it to turn out. We're at the end of the day. I wanted a sharp sell-off. If we did not get it, I would just get out and let the day go. It's certainly a good location to take profits. We're near the end of the day. You're looking for a reason to take profits. So traders who are swinging longs from anywhere in here, I think they should get flat below the low of this bear reversal bar at the top of the channel. Okay, the day, like all trend days, has features of more than one type of trend. We have the spike and channel. We have a series of trading ranges, so it's also a trending trading range day. And the pullbacks are very small, especially since this low. So it's also a small pullback trend day, which is the strongest type of trend day. Okay, it's a weak bull channel. It appeared that it was going to have swings that were big enough to trade in both directions, but there were problems with all of the shorts. They just weren't good enough to take, except that last one. And we did not get a big bear entry bar, and we did not get follow through. So it was not a very good sell setup. Most of the bull spikes were followed by trading ranges, so lots of two-sided trading, but the bears were never strong enough to push the market down very far. Buy low, sell high, scalp, but in this case I would only buy because the sell signals just didn't look good enough, and I certainly would buy at support like the trend line below or the moving average. Certainly take profits at new highs and at resistance levels. In general, in this particular case, I think the only reasonable short was that last one, and I would get out after a couple of bars if it did not go my way very quickly. For a weak bull channel in general, where are your protective stops? In general, if it's a weak bull channel with big swings, it's better to scalp most trades, like in a trading range. And if you're only scalping, you don't want to allow pullbacks, and you certainly would get out below any strong bear bar or any strong bull bar. If you have a strong bull bar, you don't want the market to fall below its low. That bull bar is a breakout, and you don't want the market to reverse below the breakout bar on the very next bar or a bar or two later. The initial stop is below the signal bar. So for example, let's say you bought above the high of this bar. Your initial stop is one tick below its low. You could go for a reward 1 times the risk because it's a trend, and therefore the probability is 60%. If you wanted to scalp out, you certainly could. Your actual risk was probably to below the low of this bar, just a few ticks, and this probably was 2 times your actual risk. If you bought above this bar and you were scalping, thinking that the market's transitioning into a trading range, you could get out with a reward equal to your risk. Same with over here. If you want, you could try to get 2 times your risk, but whenever the market's in a trading range, I tend to go for smaller profits. Even though we're sloping up and we're channeling up, most of the price action today has been sideways. So, if I were swinging, I would probably only swing a small portion, and I probably would be inclined to scalp, most of the trades. Protective stops. If I were swinging, let's say you bought here, and the initial protective stop is below the signal bar. Every time you get a strong bull breakout bar, you could tighten your stop to 1 tick below its low. This is tricky. You could say, well, higher high, put your stop below the most recent higher low, but I would not do that. Here we had a wedge top with a bear inside bar. I would get out below that bear inside bar. I would not keep my stop down here. Here we had a lower low, right? But we still don't yet have a lower high, so we're still trending up. And instead we got a higher high. So once we went up here, I would trail it here. Once we get up here, I would just get out of longs. I think there's too much risk. We only have a few bars left to the day. Let's say you're swinging instead of scalping. Okay, let's say you bought above this bar and you went for a reward 2 times your risk. Okay, you take half off at 2 times your risk. You swing the rest. You might exit here below the wedge 1, 2, 3. Right. So the wedge is triggering with this bear inside bar. So I think you can exit the second half over here. You could buy over here and go for 2 times your risk, and you'd get out up here. And you'd take the second half off here at the reversal down into the close. If you were doing sell scalps, okay, you might short the wedge here, and you might go for part off at reward equal to risk. You look at this and you say, well, the probability is 60% that you'll get 2 legs sideways to down. So if you have a probability of 60%, you could scalp out at a reward equal to your risk instead of going to 2 times your risk. Since you're trading against the trend and we don't yet have a major top, I would only scalp the shorts. Same thing here. If you do take this short, it's so late in the day, I think you need the market to go your way pretty quickly within the first bar or two. And if it does not, I would get out at break even. Although that channel had many features of a weak bull trend, the shorts did not work. Okay? When you have any doubt, you treat it like a strong channel, and you buy and you try to swing at least part of your position, and you only buy until there are clear sell signals. There was that one clear sell signal late in the day, and then that earlier one at the wedge, but neither one had a strong bear breakout, neither one had much follow through, and neither one had significant selling pressure before those sell signals developed. The broader the swings are in a channel, the weaker the channel is, the more the channel is like a trading range, and the more you should trade it like a trading range. Buy low, sell high, and scalp. If it's a bull channel, when you're selling, you could simply be selling out of longs. You don't have to sell into shorts. However, when you buy low, I think you should be buying for a trade, not simply exiting shorts. When it's a bull trend, you need to be looking to buy, even if it's a weak bull trend, one with very broad. Here's an example in the spider. We have a big gap down, but then a very strong reversal up. And at this point, maybe here or here, traders felt that the market was always in long and going higher. We had a couple legs down here, down, up, and then down. Traders might have bought above the high of this bar, maybe above the high of this bar, because at this point it's a micro double bottom. The market went down and up, and then down and then up. So, I think you definitely need to get long, because it's clearly always in long after this strong bull spike. So you can buy above this bar or above that bar. And at this point, you have to wonder, are we still in a trading range, or is it going to be a bull trend? I think it's always in long, so I think it's a bull trend. I personally probably would not take this short, even though it probably ended up going down enough for a scalp. For me, the trend up was too strong, and then these two bull bars are very strong. So yes, a decent bear bar, and yes, a little micro double top. The market went down on this bar, up on this bar, and then down again. I personally would not take the short. However, I would take the long. Two pushes down, one, and then up, and then down again. Possible higher low, so I think that's a good long. Same problem up here. Two very strong bull bars. Yes, a micro double top and a bear bar closing on its low, but I think too much risk of the market going sideways instead of down. So I probably would not take that short. I might with the bar closing on its low, but I would be much more interested in looking for buys. Here, at this point, we can draw some semblance of a channel, either based on a parallel of the line up here, or based on a rough approximation of what's going on with these two lows. We're near the bottom of it, and we have a bull inside bar, buy low, sell high. Anytime the market's down 5 or 10 bars, it's low, and I'd like to buy. We're clearly forming higher highs and lows. Aggressive bulls would simply buy the close of this bear bar and put a stop below this higher low, betting that the bear attempt to break out below this higher low will fail. So aggressive traders, as soon as they see that bear bar, they'll say, wow, we're getting pretty close to this low. The bulls should come in pretty soon. And what better price to buy than where the bears are strongest, because they'll probably get trapped. Again, I probably would not take this short, a tail on the bottom of the bar after a very good bull bar and after a series of 5 bull bars. Up here, top of the channel, 2-bar reversal, getting late in the day. We might get a bigger pullback, 3 pushes up. I think that's not a really strong sell. We just have too much buying pressure in here. My preference in general, if I'm not confident about the counter trend trades, and if they're not perfect, I prefer in general just to go with the with trend trades. Again, another higher low. Yes, a strong bear spike, 4 consecutive bear bars, but we still held above the prior low, and we're trying to break to the upside. We have a high 2 legs down, 1, 2, and a 2-bar bull breakout, so a high 2 breakout, and then we have a pullback, and then a 2-bar reversal for a breakout pullback buy. I would take that buy. So for me, the buys look good. The sells, to me, look less certain. You can take them. This one, this one, and this one ultimately ended up being profitable. But if the channels are not very broad, and if the buying pressure is as strong as it has been all day, and if the sell signals are not absolutely perfect, my preference is simply to look to take the buys. Alright, so what's going on here? We have a bear trend, a trend line break, a higher low major trend reversal in the form of a double bottom, and then a 4-bar bull spike, and now we're starting to get higher lows and higher highs. Okay, are the pullbacks going to be too small to make profitable trades, or will the channel be very broad and will it be a pretty weak bull channel? At this point, we don't know. I do know that you can draw a trend line across these lows, and there's probably not enough room for a short here, despite this being a second entry short. So I probably would not take that short. and it turned out to be a high 2 buy in a bull trend. Bear signal bar, probably not strong enough for a scalp, not high enough probability for a scalp, but I do think you can take it for a swing and put your stop below the most recent higher low. Once you had this strong bull close, you probably could raise your stop to below the low of that bull bar. Here, another high 2 buy. The high 1 never triggered. The market went up and down, and then up and down. So it is a high 2. You can call it a high 1 if you want. You can call it a failed breakout of an II. We have an inside bar, bear breakout, and immediate reversal up. This is a short that I would take. II, possible final flag. We're near the top of the channel, a failed breakout above the top of the channel. We're testing the high of the day, and we have a pretty good looking bear reversal bar. And this is one of the best bull bars of the entire trend. So it could very well be an exhaustion gap, an exhaustive buy climax. So this is one I probably would short, at least for a scalp. Near the bottom of the channel over here, so I think you could argue to buy this for a rally into the close. With 7 or 8 bars down, I probably would wait for a second entry buy or a stronger signal bar, so I probably would not take that buy. Okay, is it a weak bull channel or a trading range? When the market's early in a weak bull channel, it's usually also in a trading range. So a weak bull channel usually begins within a trading range, and it doesn't matter which you call it or which will ultimately prevail until it clearly stops being a trading range. The best way to trade it is buy low, sell high, and scalp. Here's the daily spider chart. Okay, you can argue the entire chart's a trading range. You can argue that it's basically trading range activity here. Certainly from here, this could still be a trading range, and it's clearly forming higher lows and higher highs. So it's a bull trend, right? Higher highs and higher lows, reasonably big swings. So it's a weak bull trend. In other words, it's a channel, but it's also a trading range. You can begin to draw a channel line, and again, you might be able to short the new highs, but since it's a bull trend, I definitely want to buy the higher lows. So the market is in a trading range, but it's also in a weak bull channel with very broad swings. At some point, one side or the other will win. I mean, it'll either remain as a trading range, or traders will give up on the trading range notion and they'll conclude that it's simply a bull trend. Because it still is a trading range, you can buy low, you can sell high, and you can scalp. And that includes selling reversals after every new high. If you get a sell signal bar at a new high, you can sell below it. And if you even get a pretty strong bear close at a new high, you can sell it, especially if you use a wide enough stop, like maybe 2 times the range of the bar. So for example, we have a new high. See, every new high, it reverses. New high, reverses. Bear bar, reverses. A new high, bear bar, reverses. New high, bear bar, probably is going to reverse. You could sell that close, or you could sell 1 tick below its low. You would be filled on the open of this bar. This is a daily chart. And you want to exit somewhere around the middle of the channel, because you don't try to exit at the prior higher low, because the market keeps turning up above prior higher lows, and the market probably will not reach down here. Since you're shorting in a bull trend, yes, it's also a trading range, but you're shorting in a bull trend, it's probably good to see if you can get 2 times your initial risk. So your initial risk is here, your entry is here on the open of this bear bar, and that would be your initial target. So as I said, you could either sell below the low of that bar, or you could simply sell the weak close of that bar. And then once you had this bear bar, you could put your stop above the high of this bar. Or at the moment that you sold this bear bar, you can allow for the market to go up a little bit more. Maybe put a stop in twice the height of the bar to allow a little bit more up before it turns down. And you're looking to take profits somewhere in the middle of the range, which in this case I have the target 2 times the height of that bar in case we go down immediately, which we did starting on the very next bar. So here you'd be filled. And why does this have a bull bar? Because lots of traders bought at around 2 times the height of that bar. It also fell below this small higher low, and a lot of traders, when there's any kind of trading range activity, will buy below higher lows and they'll sell above prior highs. If you did have your limit order at that red line, the market opened below that red line, you would have been filled on the open. Again, this is a daily chart of the spider. Okay, so either a trading range or a broad channel. You could have a higher low major trend reversal after a lower low major trend reversal, and then higher highs and lows. And the market could still be trending even though it's still mostly sideways. You can assume it's a weak bull trend and buy above the prior low and scalp all above the prior high, scalp out of the entire position above the prior high. You could scalp out part at the prior high and then swing the rest and put a stop below the most recent higher low. If the market's below the midpoint of the bull channel but above the low, the most recent higher low, you can buy above the prior bar. You can buy the close of the bar if it has a bull body and just put your stop below the most recent signal bar or below the most recent higher low. Okay, on this bull bar here, you're below the midpoint of the most recent leg up and you have a bull body. I think you can buy that bull close and put a stop below the most recent higher low and go for a target maybe twice the height of the bar, which would be at a new high. Once the market turns up, you could do a measured move based upon the actual risk, which is below this low, or you can simply just take profits above the prior high. If you don't get filled at your initial target and you have a weak close on the bar, since you're at a new high and a weak bull channel and the market tends to reverse down at every new high, just get out at the close of the bar. Okay, here, excuse me, looks like we're getting a strong bull breakout. You'll probably exit, if you're exiting at the prior high, you would have been filled with this big bull bar. So let's say you exited half, you could swing the other half with a stop below the most recent higher low, thinking that if the market does pull down again, it will do like it's been doing all along and stay above the most recent higher low. If you entered later, if you instead of buying at the bull close in the middle of the channel, if instead you wanted to buy above the high of a bar and you kept placing buy stops above the high of the bar, so you placed a buy stop above the high of this bar, you would have been filled on the open. Okay, the risk is greater, so your risk would be below this low. With a bigger risk, you have to go for a bigger reward. It's probably still a 60% trade, 60% certain that you would make a risk, at least a reward at least as big as your risk, because it's a bull trend. So if you bought this open, in other words, one tick above the high of this bar, you would have been filled on the open. Your stop is below the low of this bar. Your reward, you'd want it at least one time as big as your risk, at least as big as your risk. So you could place a limit order and get out there. Again, since it's a bull trend, it's high probability, 60% or so. Okay, we're above the prior bar. You could exit on the close of this strong bull bar, just like strong bull bars up here led to reversals. Once you have a strong bull bar, you can make projections based upon the actual risk. So if you bought this close, your actual risk at most was below the low of the bar because the market went up immediately at that point. So your actual risk is from your open to 1 tick below the low of the bar, and 2 times your actual risk is that red line there. So theoretically, you could have taken partial profits at that red line, even though it's below the prior high. Okay, so we got a couple decent bear bars. Alright, so what about buying up here? Okay, possible high or low. After those 2 strong bear bars, I would not buy. And what about shorting here? Let's say you decided, strong bear bar, another strong bear bar. Maybe I should go short on a stop below the low of this bar. If the market gapped this far down into the prior leg, I would not take that short. So at this point, I would be confused and I would wait. I could not short this far down, and the setup is not strong enough for me to buy yet. So when you're taking sell signals in a bull trend, even if the bull trend is in a broad channel, I would only take very strong sell signals, and I would only sell near the top. Okay, so you're getting a series of highs and lows, so it's clearly a bull trend, and I would only sell if I had a very strong sell signal, and I would not sell halfway down into the channel. After a weak leg up, you can, at a new high, you can sell below a strong bear signal bar, and you can sell below any signal bar if it's a second signal at a new high. After a strong leg up, don't sell unless there's a second signal. So a pretty strong leg up, I would not take that short. You can argue second signal, but the market opened down here, and I would have pulled my order before the open when I saw that it was going to open this far below the high. So what about selling up here? Arguably a second signal, first signal here, second signal there. I would not. You've got 2 very small doji bars, not a lot of selling pressure. I would not take the shorts. Okay, I mentioned that. To me, I would not sell down here. I would only buy. And as far as buying this bar, to me, I would only buy it for a swing, and my stop would be down here. It's too high above the bottom, and it's after 2 strong bear bars, so that's not a strong buy setup. Let's say you bought the open of the bar or the close of the bar, and the market gapped up on the next bar. You can determine your actual risk, 1 tick below the low of this bar, and that's 2 times your actual risk. You could scalp out part there. And the market then entered a very tight channel. What about exiting up here? I don't know. You could take partial or full profits here. We poked above the top of a very tight channel, and we have a strong bear bar. But I think it's also okay to continue to swing part of your position. At this point, where's your stop? Probably still below the most recent high or low. And you can see that sell failed, and we got a triangle. 3 pushes down, 1, 2, and 3, and then a bull breakout. Once you have this bull bar, I would trail my stop to below this low or below this bull bar. And after this additional bull breakout, I'd put my stop below that low. And that is the end of the module on trading weak bull channels.